We were discussing about the corporate tax rates applicable at present, as also we have solved a problem from the study mat, how to compute taxable income, giving some ideology on some aspects of allowance or disallowance of expenses, like depreciation as per IT Act and depreciation as debited, or recovery of bad debt over bad debt already disallowed earlier, there is excess recovery, etc., etc. Today we will be discussing, and I think once again I think that the problem solved online through screen share was possible to be understood by you. Now today we are entering into the new aspect of our discussion in unit 1, that is minimum alternate tax on companies, popularly known as MAT, section 115 JB. The background history of MAT introduction is that, under the Income Tax Act, there are so many exemptions and deductions available. And it has been observed in the past that many companies, after considering all the available exemptions and deduction in a lawful manner, were not in a position to pay tax at all to the government exchequer, causing much of distress into the realization of fund through tax revenue from the corporate bodies, and creating much problem for providing finance for different government public expenditure programs. Because if the companies in general take into account all the available exemptions and deductions provided under the Income Tax Act, in many cases, they are not in a position to pay tax a single rupee to the central government or to the central exchequer. This is really a troublesome situation. To tackle this situation, a new section under section 115 JB of the Income Tax Act was introduced some few years back. And this section is to curb the practice of paying no tax to the government by availing, though legally, all the exemptions and deductions available under the Act. Now, what is the basic implication of section 115 JB? Section 115 JB actually deals with MAT provision, minimum alternate tax. Means whatever may be the exemptions and deductions availed by a company, a minimum amount of tax is to be paid to the government. So, by virtue of section 115 JB, it is provided that, where it is seen that the tax liability computed under the normal provisions of the Income Tax Act of a corporate body, whether it is a domestic company or a foreign company, in both cases, MAT is applicable. If it is seen that the tax liability computed under the normal provisions of the Income Tax Act of a corporate body is found lower than the tax computed on book profit as computed under section 15 JB of the Act, then by virtue of section 115 JB, the corporate body shall be liable to MAT provision, and the book profit so computed under the MAT provision of section 115 JB shall be deemed or shall be taken to be the deemed profit of the corporate body for the relevant assessment year, and the MAT liability shall be the tax liability of the corporate body for that assessment year. However, under the Act, where MAT provision is applicable, that is, where tax liability computed under the normal provision of income tax is found lower than the tax liability computed under book profit in terms of section 115 JB, then the company is entitled to get tax credit under section 115 JAA for payment tax based on book profit, not on normal profit as computed under the normal provision of the Income Tax Act, and this credit can be carried forward for a maximum period of 15 years from the end of the previous year in which MAT liability was paid by the company. Now, as we have already stated that under the MAT provision in terms of section 115 JB, every corporate body, whether it is a domestic company or a foreign company. In the last class, we have discussed what is meant by a domestic company and a foreign company. Both are liable to MAT if it is seen that the tax liability computed under the normal provision of the Income Tax Act is found lower than the tax liability computed on book profit in terms of section 100 JB of the Income Tax Act. And in that case, when MAT provision is to be taken into consideration, the tax rate shall be 15%. You know, in case of corporate body, the tax rate is usually depending on the volume of or level of turnover or gross receipt exceeding 400 or not exceeding 400, as discussed in the last class. If it exceeds 400 crore, the tax rate shall be 30%. If it does not exceed 400 crore, then the tax rate will be 25%. And in some cases, those companies are opting for section 115 ABA, BA, ABB, etc. That is, they are not interested to enjoy any tax, any deductions or exemptions, then the tax rate is somehow lower. But in general, the tax rate is either 25% or 30%. But in case of MAT provision, the MAT liability or MAT is computed not at 25 or 30, at the rate of 15% of the book profit plus surcharge, as discussed earlier, that is 7% if the taxable income exceeds 1 crore, or 12% if the taxable income exceeds 10 crore. Plus education cess is applicable. In case of foreign company, MAT liability shall be 15% of book profit, and I have already discussed, plus surcharge at the rate of 2% if the total income exceeds rupees 1 crore, and 5% if the total income exceeds rupees 10 crore, plus education cess as applicable. Now we see that under the MAT provision of section 115 JB, there is one term, book profit. This book profit is not the profit maintained in the books of accounts of the company. This book profit is to be computed in terms of provisions discussed in section 115 JB by considering the net profit as shown in the profit and loss account by the company for the relevant previous year, plus some adjustments whereby some items are added back and some items are deducted. What are the items are to be added back and what are the items are to be deducted in computing book profit of a company so that MAT provision can be applied? We have to follow the list. Students, you may follow page number 18 of the study material already supplied to you, or you may have with you, wherefrom you can see that the following items are to be added back in computing book profit of a company. The first item is very much important. Income tax paid or payable plus provision for income tax, if any, including dividend distribution tax, tax on dividend distribution, interest, surcharge, education cess, etc. All these are to be added back. If you have deducted in your P&L account all these items, these are to be added back. Second item, any amount carried to any reserves by whatsoever name called other than amount transferred to special reserve under section 33 AC. Under section 33 AC, a company is required to transfer a special amount to a special reserve. That reserve is not to be added. Other than that, amount carried forward to any reserve shall be added by whatsoever name called. Third item, amount set aside to provision for meeting liabilities other than unascertained liabilities. That is, if there is provision for liabilities and the liabilities are not ascertained, the estimated value for any liability for which some amount is set aside, that has to be added back. Amount or provision for loss of any subsidiary companies to be added back. Amount of dividend paid or proposed dividend to be added back. Amount of expenditure relatable to any income to which section 10 other than 1038 11 other than 1035 1038 and 11 and 12 apply. That is, any expenditure relatable to any income relatable to any income under section 10 11 12 but not 1038. Amount of depreciation charge, whatever depreciation charge in P&L added back. Amount of deferred tax and provision made therefore, that also has to be added back. Amount set aside as provision for diminution in the value of asset. If you have set aside any provision for diminution in the value of asset by means of revaluation, that has to be added back. Amount standing in revaluation reserve relating to revaluation of assets on retirement of disposal of such asset if the same is not credited to P&L account. That is, whatever amount is standing to any revaluation reserve on retirement or disposal of asset not yet credited to P&L, that has to be added back. These are the items to be added back. We will be discussing later on. Then what items are usually to be deducted in computing book profit, so-called book profit, so that we can compute tax liability under that. Amount withdrawn from any reserves or provisions and credited to P&L. If any amount is taken from any reserve or provision and it has been credited to P&L, that has to be deducted. Amount of income to which section 10, 11, 12 apply other than 1038 and credited to P&L accounts shall be deducted. Amount of depreciation debited to P&L account excluding depreciation on account of revaluation of assets. Other than revaluation of assets, any depreciation debited to P&L account shall be deducted. Amount withdrawn from revaluation reserve and credited to P&L account. Any revaluation reserve credited to P&L account to the extent it does not exceed the amount of depreciation on revaluation of assets. That is, between the depreciation of revaluation assets and amount credited to P&L account from any revaluation reserve, whichever is lower shall be deducted. To the extent means whichever is lower. Amount of loss brought forward or unabsorbed depreciation, whichever is lower as per books of accounts shall have to be deducted. If one of them is nil, so then the lower is nil, so there will be no question of deduction. Amount of profit of SIC industrial unit or company commencing from the previous year in which the company became SIC and ending with the assessment year during which the entire net worth becomes positive. That is, in case of SIC industrial units, whatever amount of profit has been earned, that has to be deducted. Amount of deferred tax, if credited to P&L account, has to be deducted. So these are the items which are to be added back with the net profit as shown in the P&L account, and following items are to be deducted with the net profit as shown in the P&L account of a company, so that we can compute book profit in terms of section 115 JB. And once we are able to compute the book profit by adding some item, by deducting some item, then we shall apply 15% of that book profit plus surcharge as applicable plus health and education cess. We will be able to compute the tax liability on book profit. And if we see that the particular company has computed tax as per normal provision of Income Tax Act is lower than the 15% of book profit, as we have shown or discussed later, is found lower than 15% of book profit, then this 15% of book profit shall be taken to be the tax liability of the company for the relevant assessment year by virtue of section 150 JB. This is the situation. So now we can have an application of these by means of considering a problem as has been given in example 1.3, page number 20. You see there is a problem, and I will be sharing a screen to this respect so that you can understand how the additions are being made or not. Today we will be taking the problem or example given in 1.3 in page number 20 so that we can compute whether 115 JB will be applicable or not in the case of TK Limited. TK Limited of TK Limited. Here we read the problem. TK Limited is an Indian company, earned a net profit of 27,85,000 as per books of accounts after debiting or crediting the following in its profit and loss account for the year ended 31st March 2021. So for the assessment year 2021-22, because previous year was ended on 31st March 21, that is 2021 is the previous year, so assessment year will be 21-22. Now we can compute how to compute book profit. You see here, net profit is 27,85,000. So we'll start with this. Net profit as per profit and loss account will be taken here. 27,85,000. Then we have to take some items to be added. So add items added back as per section 115 GB colon. What are the items? Here you see first item, provision for income tax. Once again we are coming back to page number 18. What items are to be added? Any income tax paid or payable, any distribution of dividend distribution tax or tax on dividend income, interest such as education, etc. to be added back. Here we see provision for income tax. So provision for income tax is to be added back. So first item, provision for income tax. What is the figure in the problem? 4,30,000. So we'll be taking here 4,30,000. Then what is the next item? Wealth tax. In the theoretical part, what items to be added? We have to add income tax paid or payable, not wealth tax. Surcharge education says to be added back, but not wealth tax. So if any there is wealth tax, sales tax, any other tax, that shall not be added back. So wealth tax of rupees 98,000 as debited to P&L account shall not be added back. Then transfer to reserve. You see we have seen here any amount carried forward to any reserve other than special reserve 33 AC. So this is not 33 AC, transfer to reserve. So this item has to be added back. Transfer to general reserve. The figure is shown here. How much? 3,61,000. Then in the problem, provision for gratuity. Gratuity means a payment made to the employees after their completion of service. Gratuitous payment. But this is not actual payment. This is a provision. So this provision is unascertained liability. This is not ascertained liability that we have to pay. We have simply made a provision. So this 1,05,000 is to be added back, because mentioning here amount set aside, point number C in page number 18, amount set aside to provision for meeting liabilities which are unascertained or other than ascertained. Jegulo ascertained, which are not ascertained, that have to be added back. So provision for gratuity has to be added back as debited in the P&L account to the tune of 1,05,000. Then we see securities transaction tax. It is not income tax, so it is allowable as deduction, nothing to be added back. If it is income tax, it would have been added. Then proposed dividend, any dividend paid or proposed shall be added back, because these are not expenditure of the company. So proposed dividend to be added back. Proposed dividend, what is the figure? 1,11,400. Then provision for losses of subsidiary company, clearly stated. Amount or provision for losses of subsidiary companies under section 1 are to be added back. So it is to be added back. How much? 76,000. Provision for losses of subsidiary company. Provision for losses of subsidiary companies. Figure is 76,000. Then expenditure to earn agricultural income. Expenditure to earn agricultural income. You see here, amount of expenditure relating to any income to which section 10, 11, 12 apply. You know that agricultural income relates to section 10(1). It is exempt. So expenditure to earn agricultural income has to be added back. I ask you to come on to page number 18 and see the point in F. Amount of expenditure relatable to any income to which section 10, 11, 12 other than 1038 applies. Actually, section 10(1) deals with agricultural income. So this expenditure on this type of income is to be added back. So expenditure on agricultural income is to be added back. It is how much? Seen from the question 1.3, 28,500. Then next item, expenditure to earn long-term capital gains exempt under section 1038. You again come on to page number 18. It is clearly stated, any expenditure relatable to income other than 1038. So if it relates to 1038, it should not be added back. So expenditure to earn long-term capital gains under section 1038, 49,300, 49,000 is not to be added back. Depreciation, including depreciation of 1,23,000 on devaluation, that is different issue. Total depreciation is 3,25,000 mentioned here. Any depreciation charged, amount of depreciation charged to be added back under point number G in page 18. So depreciation has to be added back. And the figure is 3,25,000. So these are the items as has been debited in the P&L account of the company are to be added back to compute the book profit under section 100 JB. And the total of this figure is how much? 14,36,900. So adding these items with the net profit shown in the profit and loss account, we get the figure. How much? 42,21,900. So after adding some items, this is the net profit adjusted in terms of section 115 JB. Now items are to be deducted less items to be deducted in terms of section 115 GB. We see what are the items credited to P&L account. Amount credited to P&L accounts from special reserve. Amount credited to P&L accounts from special reserve 1,23,700. You come on to page number 19. You see that first item to be deducted, amount withdrawn from any reserve or provision and credited to P&L account has to be deducted. So this amount credited to P&L account from revaluation reserve of amount credited to P&L account from special reserve 1,23,700 has to be deducted. It is as it is included, it should be deducted. So amount credited to profit and loss account from special reserve, this has to be deducted. What is the figure? 123,700. Then what is given in the problem? Amount credited to P&L account from revaluation reserve 1,45,000. You see here amount credited to P&L account from revaluation reserve, it is 1,45,000. You come on to here to consider item C in page number 19 is related. Sorry, amount D related. Amount withdrawn from revaluation reserve and credited to P&L to the extent it does not exceed the amount of depreciation on revaluation of assets. That is, whatever you have credited to your P&L account through revaluation reserve to be added, to be deducted to the extent of the depreciation on revaluation of assets. You know, earlier whenever there were depreciation, within bracket there are figure including depreciation of 1,23,000 on revaluation. So this 1,23,000 and your credit from revaluation is 145. So this 145 is not to be deducted. It shall be deducted to the extent of depreciation on revaluation of asset, that is 1,23,000. So we will be considering 1,23,000. Writing this way, amount credited to profit and loss account from revaluation reserve to the extent of depreciation on revaluation of asset. Bracket A, limited to the extent of depreciation on revaluation, that has to be. So what is the figure? It is 1,23,000. You see once again here in the problem page number 20, item B, second item, amount credited to P&L from revaluation reserve 1,45,000, but your depreciation on revaluation is 123. So amount to be deducted to the extent of depreciation, that is 1,23,000.